In today's episode of the MSA Rental Market Update, we are looking at the Seattle rental market for conventional multifamily properties. As you can see, the Seattle MSA is drawn here by CoStar and where it is in relation to Portland, the Canada border. Here is Spokane. We've got Montana over here, Boise, Idaho here, Reno and Sacramento, California here, and Portland, Oregon down here. But I believe I said that already. So now that you know kind of where it is located, let's take a look at the filters. And you will see that, as usual, we are excluding corporate, military, senior, and vacation, and we are only including market and market affordable, so that we are only looking at conventional apartments. So let's go take a look at the supply snapshot first for all asset classes combined, and then we'll look at the rent analytic data for each individual asset class. So here is the supply snapshot for the Seattle metro statistical area. There are 11,782 properties in this large market, totaling 386,119 units. There are still 28,558 units under construction, and in the last 12 months, 2,338 more units were rented than went vacant, where the previous 12 months, almost 13,000 more units were rented than went vacant. We can see that slow down in absorption because 12 months ago, vacancy was 5.2. Today, it is 6.9%. There was a very, very slight, I'd say, really no rent growth at all between the last 12 months, year over year. We'll see what it looks like quarter over quarter. We only have a $3 change in rents. As usual, we are not looking at the capital markets. We are only looking at the space market. If we come down and look at the long-term occupancy average, we can see that this market likes to be around 93 3/4, and it's currently sitting right at 93% occupancy. So slightly below, can probably argue on that long-term occupancy average. At the end of this analysis today, we will jump into the market cycle chart, and I will plot where Seattle is located on this market cycle chart. So make sure you stay to the end to see that. So let's go take a look at the analytics and the data and see what it shows us for all asset classes combined. So here is the rent analytic data for the Seattle metro statistical area. As usual, we are not looking at asking rents. We don't care what the owners are asking. We only care what they are collecting. So we look at effective rent. Looking at first quarter 2022, they were getting $1,915 a month on average for all three asset classes combined. It went up to $1,986 in the second quarter, then down to $1,954 in the third, down to $1,903 in the fourth, and then first quarter of 2023, it looks like we had a tick up. Let's see if demand supply principles tell us that that should have occurred. As we saw with Birmingham yesterday, it absolutely did not. I think we'll see it a little differently here for Seattle. So let's look at our deliveries and absorption. So we can see that there were 2,513 units delivered in the first quarter and 2,250 absorbed. Really good absorption. Then we had 3,593 units delivered, only 2,220 absorbed, so not so good absorption. Then we had another 3,572 delivered and only 1,157 absorbed. That's not good at all. Another 1,160 delivered and then another 748 went vacant. So between the fourth quarter and first quarter of 2023, fourth quarter 2022, first quarter 2023, we are negative absorption by close to 900 total units. Yet we saw a rental increase in the third quarter. Once again, demand supply principles going the wrong direction. Let's see if that's limited to one asset class or if it is spread across all three asset classes. Let's go take a look at Class A first. So here is the rent analytic data for Class A properties in the Seattle metro statistical area. There are 623 properties, totaling 104,221 units. Looking at effective rent, first quarter of 2023, the rent was $2,319 a month, went up to $24.19 in the second quarter, down to $23.71 in the third, down to $22.80 in the fourth quarter of 2022, and then ticked up in the first quarter of 2023 to $23.15. Let's see if rental demand says it should have done that with absorption. Okay, if we look, we can see there was 1453 delivered, 1090 absorbed, so not strong but not bad either. 2016 delivered, 1706 absorbed. That's good, strong absorption. I like to see 80% or better. 2042 delivered, 1227 absorbed, so it was a little slow down there, not very good delivery. 311 delivered, good strong absorption of 463. Then 763 delivered and so good strong absorption. So we are seeing an increase in occupancy in the Class A market. That's interesting. We don't see this a lot with the Class A properties across the country, but it looks like that the Seattle metro statistical area likes their Class A properties and that they're okay with these rents right now. So that is very, very interesting. So yes, if we go back and look at our rental increase up to $23.15, I would agree that it deserved a rental increase. So Class A in Seattle holding very strong right now. That's really interesting. Didn't expect to see that. Let's see if the Class B story tells the same thing. So here is our Class B rent analytic data. There are 2,264 properties in the market totaling 138,831 units. Looking at effective rent, we started the first quarter 2022 at $19.23, went up to $19.94, down to $19.61, down to $19.15, and then ticked up to $19.35. So we've seen this with all three data sets we've looked at so far. Let's look at deliveries and absorption, and we can see that 1,022 delivered in first quarter, good strong absorption, 1,046 absorbed. 1,573 delivered, only 663 absorbed, not good absorption there. Same thing with the third quarter, 1,506 with 666. Only absorbing, not good absorption there, and then 849 delivered. And another 315 went vacant, then 798 delivered, and another 136 went vacant. So we should not have seen that increase in rent, and my guess is from that strong absorption in Class A's, and Class A's and B's not being too far apart from each other, only a couple of $100 a month, that some of these renters may have went to the Class A space. That's just an assumption. We could also argue that some of these may have doubled up and entered the rental market as roommates, or they could have went and purchased a single-family home. We did have strong growth in single-family across the country in the first quarter of 2023, which was a backwards trend from what it's been doing. It had been declining, but we did see some growth. It's now declining again because those interest rates came back up. But in February, we did see strong demand by homeowners for purchasing, and so there is a possibility that this could have happened there. In either case, it doesn't look like the Class B space for demand is holding. Way too early to look at quarter to date, second quarter. We won't look at second quarter until we get about 3 weeks into the third quarter. So just ignore that up there. So we do have a very big weakening and negative absorption in Class B. Let's see what Class C tells us. So here is our Class C rent analytic data. There are 8,075 properties in this market, totaling 141,678 units. Looking at effective rent, we started first quarter 2022 at $14.89, up to $15.31, down to $15.16, down to $15.01, and then slightly up to $15.13. Let's see what absorption tells us, because we should have no deliveries. It's showing a few, but you don't deliver to the Class C space. If we just look at absorption, we could see that absorption is absolutely deplorable in the Class C market. This is saying that we should continue to see those rents trend down. A little shocking, even though we do have really high occupancy of 94.5. So I guess it's not too terribly shocking. We are above that long-term occupancy average in the Class C market. But that typically is telling us, when you see negative absorption like this, that the Class C renters are no longer willing to pay these prices, and they want to see these rents come down. So these renters will not jump to the Class A space. You don't see Class C jump into Class A. What you're seeing here is they are probably roommating up so that they can afford the rents, and this is showing it. So my guess is we'll see the Class C market start to decline from this point. So what does this mean for Seattle? Let's look at our market cycle chart. So we know we were about 0.75% under the long-term occupancy average. One can argue on the long-term occupancy average, but we have some discrepancies between the different asset classes. If we were to plot this per asset class, there's a good chance we're plotting Class A, maybe on this side of equilibrium, because we still have absorption exceeding deliveries in the last couple of quarters, which is really, really interesting. We did have some negative growth quarter over quarter in rents, but then it came right back to growing again. So one can argue it could be on Class A, could be on either side of the equilibrium line, and nobody would argue with you if you put it over here in expansion, because of the demand for the renters with absorption exceeding the deliveries really points it towards the expansion side. But for the rest of the asset classes, B and C, we probably put B right here on the long-term occupancy average, and C's maybe slightly above it, because the C's were, even though we're negative absorption in 4 of the last 5 quarters and strong negative absorption, we still are above that long-term occupancy average for Class C's. So maybe we plot Class C's right here in between these 2 points. We plot Class B right on the long-term occupancy average, and Class A on this side of equilibrium in the expansion. So this is the sign of a market where you can really break each asset class down into different parts of the market cycle chart, where a lot of the markets, especially down in the Sun Belt, they kind of all follow each other together, and we plot the whole market just on one plot point somewhere on the chart. So overall, where would I place the Seattle market? Probably pretty comfortable plotting it right here, because C's and B's are waning. We'd probably plot it right here in oversupply. We're definitely slowing in absorption, with 28,000 units still left to absorb. So the overall market probably right here on this point in oversupply, and is trending downward. We'll see how the A's continue, see if they keep that growth going, or if they start to follow the B's and C's. So that does it for the Seattle, Washington metro statistical area. Stay tuned tomorrow as we look at Charleston, South Carolina.